everyone, welcome to Succeed Learning app. In today's session, we are going to see Economic Chapter 2, Public Finance and Budget. Today, let us discuss about where do we get income from and how much income does a family get. Just tell me in your family. What is the source of income? Where do we get it from? For example, this is Ramu's father and he alone earns income whereas his mother stays home as a homemaker. She manages household affairs whereas his father goes to work to earn income. But this is Shyam and both his parents go to work to earn money. Have you ever tried to know about your father's occupation? Yes, we earn money or income by doing various jobs to get salaries and wages. Few of them earn through their own business firms. Many of them in India work in the agricultural field and few entrepreneurs run industries, etc. So men and women earn money or income by doing various occupations. Let's analyze who manages family expenses, both father and mother. In most of the families, mother manages expenses and savings. Sometimes the incomes we earn will not be sufficient. Then we borrow money from the friends and relatives or from banks. We get shortage of money during marriages, health issues, children's education, etc. Then we will be in need of extra amount that we borrow from others, which is called as debts. So balancing of income, expenditure and debts of an individual or family can be called as personal finance. Similarly, government also manages nation's income, expenditure and debts. The study of this public is called as public finance. Meaning of public finance. Government raises income through revenues such as taxes or money borrowed and spent for the developmental works. In this regard, Dalton explains that public finance is concerned with the income and expenditure of public authorities and with the adjustment of one to the other. Briefly, it can be said public finance deals with the way in which government manages its income, expenditure and loans. Importance of public finance. Government mobilizes activities of rising revenue through taxes or government spends. This collected revenue for the developmental works or activities to develop nation's economy that benefits everyone. Government spends more amount during the recession period is equal to fall of economy and GDP and controls expenditure during the inflation period, that is rise in the price of goods and services in economy. And this is how government regulates economic activities. As annual budget is prepared by the government, the study of public finance helps us in budget analysis and evaluation or accessing the annual budget of the nation. Now, let's discuss about the meaning of budget. Let us learn what is budget, who prepares it and what presents it. Now, let us discuss about the meaning of budget. Let us learn what is budget, who prepares it and who presents it. Budget meaning the statement of estimated income and expenditure of a year prepared by the government is called budget. Both central and state government prepares their own budget. Finance Minister presents budget in Lok Sabha in the month of February or March. Financial year begins on 1st April and ends on 31st March. Budget for next financial is prepared in the current year. Let's see a few important highlights from a budget our present Finance Minister announced this year. Concessional corporate tax of rate of 15% to new domestic companies in manufacturing and power sector. Tax concession for sovereign wealth fund of foreign governments and other foreign investments. To tax benefit to startup by way of deduction of 100% of their profits are enhanced by increasing turnover limit and period of eligibility. increasing coverage of artificial insemination to 70%, doubling of milk processing capacity by 2025. About 150 higher educational institutions will start apprenticeship embedded courses, internship opportunities to fresh engineers by urban local bodies, special bridge course to improve skills sets of those seeking employment abroad, degree-level online education program for students of deprived sections of the society. Indian SAT to be conducted in Asia and Africa under study in Indian program. Types of budgets. There are three types of budgets: surplus budget, deficit budget and balanced budget. Surplus budget. If budget shows excess revenue compared to expenditure, it is surplus budget. Deficit budget. If the budget expenditure is more than revenue, it is called deficit budget. Balanced budget. If both income and the expenditure are equal, then it is called as balanced budget. For example, in countries like India, which is still a developing nation, have plenty of development activities to be completed, such as infrastructure, health, education, children and women welfare, etc., which are very essential for the nation and its people. In such conditions, government spends more income on development to achieve its economic progress. So, in developing countries like India, keeping the welfare of the people in the mind, the expenditure is always done revenue, more than the revenue. So, government normally prepares deficit budget to gain economic progress in the nation. Public expenditure. The expenditure incurred by central, state and local self-government to satisfy the social wants of the people is known as public expenditure. By 20th century, the role of government has expanded to create and maintain conducive conditions for the economic development of the nation. It has to improve the conditions to save, invest and innovate research that in turn it helps in the growth of the economy. Goals of public expenditure: to promote faster economic growth, to promote industry, trade and commerce, to promote agriculture and rural development, to provide balanced regional growth, to build roadways, railways, dams, power, etc., to provide full employment and maximum social welfare. Public revenue. Public revenue is income realized are collected through the taxes or non-tax sources by the government for financing purposes of government activities. This amount of revenue is raised by the government-owned corporations, public wealth funds and grants, etc. Next photograph, as the income is rising, the requirement of the public is also increasing. For example, government is collecting amounts in the form of various taxes and turn spending on the welfare of the people and development works to satisfy their social requirements such as roads, water supply, electricity, public libraries, free hospitals and free medicine, free distribution, etc. We shall now try to briefly understand the sources of central and state government. The central government collects its income from various sources. These sources can be classified into two heads: revenue receipts and capital receipts. Revenue receipts. The revenue generated by the government through taxes and non-tax resources is called revenue receipts. It comprises revenue from both tax and non-taxes revenues. Tax revenue. Taxes are major source of revenue to government, paid by citizens compulsorily without any direct benefit. Central government imposes several types of taxes such as income tax, corporate tax, GST, etc. Government imposes higher tax on rich class, poor class are exempted from tax. Lower taxes on common man. It is called as progressive taxation. The taxes imposed by central government are of two types: direct taxes, indirect taxes. Direct tax is paid by the individual on whom it is levied. The burden of these taxes is not transferable. For example, income tax, corporate tax, stamp duty, etc. Indirect taxes are imposed on goods and services. The burden of tax is transferable to others. For example, tax on goods and services is labeled on manufacturer. It is transferred to trader and from trader to consumer. It means that tax levied on the manufacturer is ultimately paid by the consumer. For example, central excise duty, VAT, service tax, import, export tax, etc. However, government introduced a single tax GST from 1st July 2007. Non-tax revenues. Government gets revenue from the other sources apart from taxes. Such revenue is called non-tax revenue. The main type of profit earned on revenue generated by Reserve Bank of India, Indian Railways, Post and Telecommunication, public sector industries, minting and coins, bills, fees and penalties. Capital receipts. The receipts that create liability or cause reduction in the assets of the government. For example, receipts from sale of shares of public enterprises leads to reduction in assets of the government. Hence, they are called as capital receipts. The government generates capital revenue through other sources. The government generates capital revenue through other resources with the investment in industries. It means disinvestment. Sometimes state governments repay the loan taken from the central government. Public debt. The government borrows money from other sources is called public debt or loans. The loans obtained from banks or financial institutions and from citizens of a country is called as internal debt. The loan obtained from foreign government, foreign or international financial institution is called as external debt. Deficit financing. As we have learnt earlier about the government while preparing annual budget, first estimate its expenditure on development works and then plans the revenue. In developing countries, public expenditure is higher than the public revenue. This is good for the development of the country. In order to fill the gap between the country's income and expenditure, government raises loans from the internal and external sources. To cover of this deficit in the expenditure over revenue, government usually borrows from Central Bank of India (RBI) or by printing additional currency. Thus, deficit financing can be defined as the financing the budgetary through loans from RBI or creating of new money. Four concepts of deficit are used and are calculated as shown below. Fiscal deficit is equal to revenue receipts plus non-debt receipts is minus total expenditure. Revenue deficit is equal to revenue receipts minus revenue expenditure. Primary deficit is equal to fiscal deficit minus interest payment. Budget deficit is equal to total revenue minus total expenditure. Drawbacks of high deficit. It indicates financial indiscipline of government. It increases inflation. To check such practices of government, FRBMA Fiscal Responsibility Budget Management Act was passed in 2003. It improves management of macroeconomics and reduces fiscal deficit by moving towards a balanced budget. By this, we come to the end of a chapter. Hope that everyone understood. For more information, log into Sslc Learning app.